Okay, I don't know if this makes you all feel better. I just got my little thing going here. If I get done in 15 minutes or less, Valaro owes me 20 bucks. So that's good. Well, good morning, everybody. And my name is Ken Solo. I'm the Chief Investment Officer of Pinnacle Advisory Group. And I can tell you I get a chance to do my share of speaking gigs around the country, but every year this is my favorite one since I get to talk to all of you, our Pinnacle family, and that's really kind of a neat thing. And it's also great to be here with our Pinnacle analysts and the rest of the investment team. This is the one time we let them out. And you'll notice they're kind of pale, pasty, lazy-eyed. We don't let them in public. Just a public service, kind of a safety thing. Please don't feed our analysts. Don't feed the analysts. With that, I can tell you that when I am out speaking, one of the really hot topics that's out there today is talking about the correct time horizon to evaluate portfolio returns. It turns out portfolio strategy has changed so much. It's changing very rapidly over the last 2 or 3 years, 4 years now, as firms in the industry are moving towards what we've been doing for quite a while, which is tactical asset allocation. I don't know if any of you may have heard that buy and hold is dead again. You may have heard that. And because of that, lots of questions in the industry about how do you do this, what time horizon, what questions should you be asking. And I thought then that would be a good thing for me to tackle with you for a few minutes this morning. It's true, though. We give you a lot of data to consider when it comes to your investments. We give you daily information through your custodian, obviously, composite information 1 month through our Pinnacle Monthly magazine. You get year-to-date. We update that weekly, right? You can find that in your vault. We give you triannual client-specific data on your portfolio 3 times a year with your billing. We give you trailing 1-year, 3-year, 5-year, 10-year returns with the Pinnacle Monthly. So we're giving you a whole lot of choices in terms of how you might want to look at performance and returns and evaluate what we do. And in fact, we actually asked you in our most recent survey, we did a client survey, and thank you very much for those of you who actually filled it out and sent it back. We had a huge response. I think, Brian, what did we have, over 250 responses, something like that. So a very robust response, and one of the questions was, what time horizon do you think is best for evaluating portfolio returns? So I thought you might be interested in what you all said. So here are your answers to the question. 15% said they wanted to look at portfolio returns and evaluate this monthly. 43% they wanted to do it quarterly. 37.6% said to do it annually, and 4% said they wanted to look at a market cycle. Now, granted, I think the question is a little bit, I think folks might have been answering the question, how often do they want to look at their returns as opposed to evaluating portfolios? But nonetheless, wouldn't you know that as I go around the country speaking to professional investors, I would say the correct answer is market cycle. In fact, complete market cycle. So our Pinnacle clients failed this particular quiz question, and so I thought, well, why don't we focus on that, since probably most of us don't even know what a market cycle is or care. So I thought we'd drill down there. Now, one of the interesting things about talking about investment performance is there's a couple of stress points that we need to deal with when we talk about this subject. And the first stress point, and the biggest one, is negative returns. Okay, when you're dealing with investment losses, it's very difficult to make really crisp analytical decisions. It's a very emotional situation. You get that anxious feeling, probably much like you have right now, wondering if you'll stay awake through this hour and 15-minute discussion we're doing. So we all know that anxious kind of a feeling, and that is not good really for evaluating investment returns. The second area of stress that we look at has to do with strategy and tactics. Okay, money managers tell you that they're executing some strategy, and we need to figure out what is the proper time frame to evaluate that strategy. You know, can they do it? If we're looking monthly and someone's telling you they need a year well, we're failing. If someone tells you they need 30 years, well, that's a problem. So we got to figure that out. And to kind of illustrate this, I thought what I'd do is walk you through both ends of this spectrum. So this is our actual monthly data. This is our moderate growth portfolio, which I always use as an illustration. More than about 50% of our clients are in this particular strategy with Pinnacle. And these are just the monthly returns over since inception, and you can see how noisy that data is. There's a lot of negative results in here. Essentially, if you're going to try and ride this monthly wave, you're going to find a really high stress environment. And clearly, there are not many money managers that execute a strategy monthly. So I thought, well, if monthly doesn't work, let's go to the whole opposite end of the spectrum. So let me show you just one data point. Okay, this is our Pinnacle results from inception. And here you can see we've delivered somewhere in the neighborhood of a 7.4% annualized return. We've outperformed our benchmark. There are no negative returns to be seen. There are no bear markets. It's just a nice, comforting number. And so with that, what I'd like to do is adjourn this meeting, and we'll reconvene in 2023 and take a look at how you've done. Well, obviously 10 years is way too long to ask a consumer to wait to evaluate returns. We're huge consumers of investment performance here at Pinnacle as we look at managers to put in your portfolios. So our challenge is to get somewhere between what's out there between 10 years and monthly that might fit the bill. So the next thing I wanted to look at with you was the answer that you all gave. You said we like to look quarterly, so I thought I'd show you the quarterly return numbers. You can see it's still quite noisy, lots of negatives in there from a risk perspective. You can see the parameters of the declines are down there around 8%, but it's over 3 months, so that's kind of scary if you get a -8 in 3 months. Kind of random looking. And I thought I would rank these for you so you could just see them from best quarters to worst quarters. And you can see that about 1/3 of the time you're going to get negative returns when you look at it on a quarterly basis. So no, most money managers are not going to be able to execute a strategy in 3 months. And no, this still kind of fails our test here. It creates a little too much agita in terms of our stress point. So I thought, okay, we're doing this calendar theme. We're going to stretch our calendar theme out a little bit longer. This is another way of looking. What we're going to do here is we're going to look at what's called rolling 2-year returns. So each month we go out 2 years and plot you the return. And so month after month we go 2-year return, then a month later 2-year return, a month later 2-year return. Is everybody with me what we're doing here? So you get a whole bunch of 2-year returns. And now it looks a little more interesting because all the negatives go away. The only negatives you see are right here in the 07 to 09 bear market. The amplitude of the declines are still, now you're capturing almost the entire decline in a bear market. So we're getting better. Most strategies, still 2 years, you're getting closer. So I said, well, let's go 1 more year. So let me show you, now we're out 3 years. We're rolling 3-year returns now. I think now we're onward. Now we're getting there, okay? You only have this very small number of negative returns. The amplitude of the return is a -10, which I think we can all live with. Lots of positive results. So I would say that if you're going to go about this on a calendar basis, the minimum time frame, this would be a minimum, and I'll show you why. I don't even think this is long enough. But for a minimum, I would say 3 years would be about a place where you could begin to evaluate strategy properly. Most money managers should be able to do something that you could evaluate over a 3-year period and get to a place where you should begin to get away from that emotional roller coaster of big, huge negatives and see something that makes sense. Now, I said that our correct answer had to do with market cycles, which has little to do with calendar. So let's see if we can get on the same page about market cycles. So here's a stylized look at a complete market cycle. And as you might imagine, if we go from the bottom of this market cycle to the top, that is a bull market, right? We all know what a bull market is. If we go from the top to the bottom, that would be a bear market, right? So if we string together a bull market and a bear market, now we have 2 cycles and 1 complete market cycle. Does that make sense, everybody? You with me? Okay, and if we start, let's say, at the top, and we go to the bottom, that's a bear market, and if we string together a bull market after that, then we have another complete market cycle. So in this kind of view, we have either, we can string together bear markets and bull markets are bear markets, but there we're stringing together to get to complete market cycles. In this case, there's 2 of them. All right, so let's look at this is a chart of the S&P 500 from the inception of our models in October of 2002 through present. And so now you can see here's a 5-year bull market, right, from 2002 to 2007. Here's a couple years in the bear market, and then a bull market that's lasted 4 years. And so there's that first complete market cycle, which is the bull market and the bear. So you're about 7 years. Here's the next complete market cycle, and that is 2 years in the bear and 4 years in the recent bull market. So you're in there 6 or 7 years if you want to do complete market cycles. And remember, I talked about that 3 years as a minimum. The 3 years doesn't capture this, and it doesn't capture this, but it would capture that. Okay, so we have now a little bit more perspective as we start deconstructing returns the way I think we ought to be doing this. So what I want to do is actually look at each cycle. Now, a show of hands, how many people were at Inside the Investment Committee last year? How many of you? Okay, so I don't know if you remember this, but our performance hasn't actually changed for this period of time. So bear with me if you've already seen this. But I want to walk you through our bull market performance. So now we're just looking at that first cycle. And this is just walking you through 5 years of quarterly data where the triangle is our Pinnacle investment performance and the X is our benchmark. You can see 70-some% return. We outperformed our benchmark over that period. And if you look at the just the summary in terms of annualized returns, the portfolio did 11.2% per year. We took less risk than the benchmark. A very good 5-year bull market performance. So if all you were doing is looking at one cycle, that bull market, you'd say, well, these guys are steely-eyed risk takers, outperforming with more risk. All right, let's look at the next part. The next thing is our bear market, right? The 2007 to 2009 bear market. So let's take a look at what happens here. So we're going to run through that period, and now you can see the portfolio's lost money, but the portfolio dramatically outperformed the benchmark with less risk. And everybody's with me here, right? These are returns, and here is risk. So this is the holy grail where we want to be in the northwest quadrant. This last cycle, I got a chance to update for you now. It's been a year, so there's 4 more quarters. Oh, I'm sorry. Here's the actual annualized numbers. So you see the outperformance on a relative basis, and you see the negative performance on an absolute basis. Okay, so now we're into this recent 4-year bull market performance, and you'll see the portfolio is kind of chasing the benchmark up here over this entire period, where now we get to a result in this bull market where we've earned over 60% total versus the benchmark. We've taken less risk, and if we go to the next page, we can kind of see now that you have a period where we trailed the relative return of the benchmark, but we took less risk. So I don't know if you're still with me, but we've now analyzed each part of the cycle. We looked at the bull market, we looked at the bear market, we looked at the subsequent bull market. Next step then is, you guess it, let's put this together and look at each complete market cycle. So now what we're going to do is we're going to go from 2002 to the top in 2007 to the bottom of 2009. Okay, we're going to look at the bull and the bear together. So let's see what happens. And I think we already know because we deconstructed this. You're going to see the portfolio in the bull market. We took more risk than the benchmark. But now watch, it's going to move to the left as we get through the bear market. The returns are going to drop. But we're going to end up purely in northwest quadrant performance. Okay. By the way, I just want you to know, I gave these guys, we've all been talking about don't point at the screen with your finger. Use this. And I've spent the last 10 minutes going like that. So not very helpful. Not at all. Okay, so here we are in the northwest quadrant. And the numbers for that look really pretty good when you consider the benchmark, when you consider the amount of risk we've taken. So for that complete market cycle, I think a pretty good result. Now let's take a look at the next complete, right? So now we're going to start at the top in 2007. We're going to travel through a bear market and then continue through this bull market. So let's see what happens here. Rick, how much time am I? My thing stopped. Tell me. 18 minutes. Yeah, you're killing me. You're lying. You're $20 worth of I'm like $20. I'm serious. All right, so here we go. We're over this period of time. Now we're almost knocking out exactly the same performance as the benchmark with less risk. And again, that's a performance result when you consider the fact that we have been hesitant to get fully invested over the last 4 years, considering the structural risk that we've seen in the economy. Again, a result that I think we're pretty proud of. So if you are looking to evaluate our performance over complete market cycles, those are the numbers, okay? A lot longer than monthly or quarterly. And we've kind of dived into performance. There are some other questions, though, that you should be asking, and these get to those other strategy questions, like, how long have you been executing your investment strategy? Answer, 10 years of GIPS compliant performance. Does the same team invest your strategy? Answer, yes, we are the team that delivered those numbers. Question, did your strategy work in both bull and bear markets? Answer, yes, with a caveat. It worked phenomenal in the first 5-year bull market. In this bull market, we are trailing with less risk. Did very well in the bear market in 07. Okay, when has your strategy not worked? As I said, I wouldn't say it's not working, but if we're looking to relative performance, we've made everybody a lot of money over the last 4 years, but we're trailing and have been trailing. Not trailing so much over the last 12 months, but we've talked to you about that a lot. And then finally, should we expect your strategy to work in the future? Answer, I have no idea. But fortunately, you are here this morning to hear the four folks, who have that answer for you. And I assure you, after you listen to these characters, you're going to have a good feeling about our strategy doing great stuff going forward from here. So with that, I want to thank you for putting up with me, and I want to introduce our Chief Investment Strategist, Rick Valaro.
Let's try to steal a clicker on me, too. So let's see. $20 bet wagered, and Ken's clock conveniently goes off. Who out there thinks his presentation was longer than 15 minutes? Show of hands. For the big money, right here. All right, my name is Rick Valaro again. I'm the Chief Investment Strategist at Pinnacle. And my mission today will be to walk you through some of the U.S. macro update, or give you an update. And then really what we'll try to do here is give you some flavor and a feel for the types of things we're looking at on a day-to-day basis, and then enter into our decision-making when we allocate the portfolios at Pinnacle. Obviously, there's hundreds of things to talk about. We can only take a few today. And the first thing that we're going to go to is the, Brian, one slide into my presentation has hit the wall. What's going on here? Does anyone know what this wall is? It represents, I want to guess in investment terms, what's a wall? What does a bull market climb? A wall of worry. A wall of worry, a bull market climbs. So I just foreshadowed where we're going first with this. We're going to take our pain as we go through the wall of worry right now. But if we take our pain for a couple minutes, I promise we'll come back to the good side of life here, and I'll give you some candy too. So let's take a look at what's on the wall of worry right now as we look at the U.S. macro situation. The first thing I want to talk about is just GDP growth. Okay, I think there's been a pretty long debate since 2009 in the financial community, and there's been a battle between the folks that say, look, we've earned what 130% off the bottom of 2009. No one's going to argue those are very healthy returns in financial markets, but there has been a very big outcry from many in the community saying that the economic fundamentals simply don't justify the numbers that we've gotten out of financial markets. And so I would say, look, we've gone from 2009, that's a pretty long period of time. The numbers are robust on the financial market side. I'm skeptical that the really bearish out there are correct. I mean, something had to go right to go that long and that, that kind of a magnitude return. But I will say that there are certain numbers out that you have to respect and maybe sometimes make us think about whether or not that community is right. And one of the most recent numbers that had come out that is making us think again is just the GDP numbers. Gross domestic product in our U.S. economy right here. As you can see here on our chalkboard class, we have 4 pieces to the U.S. Economy in terms of GDP. We have consumption, it's about 70% of the number, it's the driver, right? We have investment, we have government, and then we have exports minus our imports, right? So the consumption numbers that came out in the fourth quarter really actually were probably the bright spot, right? We've had about a 1.5% of GDP, running through consumption, and that's really a pretty good number. We'll take that all day long. But the business community was not as sanguine as the consumer. So we remember we had a fiscal cliff going down, a lot of worries about that at the end of last year. Clearly the business community pulled back a little bit, cut some inventories, and that contributed to a little bit of a negative number. The big part of this number, though, that we're going to talk about is really the government number. And that was the number down 1.38%, you can see, of the total number that gets into the total GDP here. Not a huge percentage of GDP, but it was such a bad number in the fourth quarter, as perhaps there was some front running of the sequester that we knew was coming, in one of the worst hits to the government sector in probably 20 plus years that we had. Last year we had exports minus imports, they were not much of a contributor. So what did we get to? We got to literally 0% growth in the economy. Now again, I've been pretty constructive on the economy over the last couple of years and not wanted to listen to sort of the more bearish community, but I'll have to admit that it's 0% growth. Trees don't grow to the sky, and markets will not continue to grow unless we can get a better performance out of GDP growth going forward. So we're going to have to watch this very closely. Clearly today, there's more emphasis in many countries, not just the U.S., on cutting debt and cutting government. And we all can admit that that's going to be probably a good thing down the road for us, right? That's probably really constructive for the U.S. economy over the long haul. But as we see, if you cut things too quickly, that could be very bad for us, in the cyclical and the shorter term time frame. And that's something we have to take, a note of here for asset markets. So whether or not GDP stalling is clearly something we're watching. And let's talk about probably the biggest component again. I just told you that the silver lining of the GDP report was in consumption, that C number that we talked about, 70% of the economy. I think one of the big worry list items out there right now is that the consumer going forward, as you look out, is set to stall. Now, why would the consumer stall? Well, there's a number of things going on here. First of all, we got into the year, it started this year with something called the 2% payroll tax, right? And that went throughout the economy. Anyone that was picking up a paycheck, it was a little light, right? So that's not a particularly good thing. That's a headwind to the economy. Number 2, we have the what's called the sequester now, which is just beginning to get going, right? It's probably, I think the estimates are maybe over the next 10 months, it'll cost us about $85 billion. The jobs cuts really haven't even begun to start. Okay, we have the furloughs and whatnot are going to start really in April. They'll start to ramp up. So to the extent that people are going to lose a few jobs, that's not going to help things either. It's a headwind. Now, last, we'll get to the actual chart that we have here on the screen. If it's hard to see in the back, let me help you out. This is the national average price of gasoline. All right, so pain at the pump would be the third thing that maybe is on the worry list here for the consumer. What you can see is the chart starts in 2011, back in February. And you've got this up and down pattern going from everywhere as low as $3 on gasoline to $4. We've been in an oscillating market for the last few years where we're going from about 3 to 4. And then we, off the boil, then it comes back to 4. And then it comes down around $3, back to 4, or close to it. Now again, the U.S. economy is fairly resilient. It can shake a lot of things off. But, what's happened after every time we got to about the $4 level is we've seen a pullback in markets. Back in 2011, we saw about a 20% drop in the S&P after we hit that $4 level. Given there were other things going on in the world, but that $4 gasoline was probably part of the equation. We get to 2012, the first quarter. Once again, we ramp up to close to $4. What ensues but about a 10% correction in the S&P 500. Late last year, we had another ramp up to between 380 and 390 on the gasoline price, and an 8% drop. So it begs the question again in terms of, here we go. We just ramped up to about 380 or so, pulling back now, thank goodness. But what's coming next here? So that's the worry here. Is you've got kind of a confluence of interest here between the gasoline price itself and a couple of the other things I talked about prior. Perhaps the consumer has a squeeze coming. So we'll have to keep an eye on that. All right, last pain point here, and this is much more structural than the last two I talked about. It's called, we're going to go over a chart called the velocity of money here. Sounds really painful and complicated, but it's really not. I can really simplify it very easily, actually. It just basically says, the velocity of money basically says that the GDP growth that we have. So I showed you that first chart with 4 components. This equation says we can simplify the whole economic situation down to a couple of things. Number one, it's the amount of money supply in the system. And number two, it's the number of times that money changes hands within the system. Okay? So plenty of money in the system right now. We know that Ben Bernanke is pumping money like crazy. I'm going to show you a chart going forward on that. The Fed is doing their job here. There's plenty of money. But the problem is the money's not changing hands. Okay? So if the money was changing hands, this chart would be going straight up. That would be probably a healthy organic economy. People are making loans. That's multiplying throughout the economy. Loans go to more loans, and the numbers go up. Instead, we have this sort of steady deterioration in the velocity of money, and that's just not a good look. It doesn't bode well. And maybe what it speaks to again is that the Fed has pumped a lot of money into the system, but not all of it is transmitting to the generalized economy. Some of it is hanging up with the banks right now. There's still a segment of the economy that cannot access credit. So again, we've had a huge run with this chart going down. So nothing to say the markets can't keep going up in the face of a poor velocity of money, but it is something that we're keeping a close eye on. All right, we made it through the tough portion of the presentation. Let's get to some rays of sunshine out in the economy, and I think that there clearly are some positive things as we look out for markets. And the first thing I want to mention is housing. And I'd like to get a show of hands because we talked about housing last year. How many people in the audience actually think that the housing market now is for real? Who thinks the housing market is healing on its own? That's pretty good. That's a lot more than we had last year when we asked the same question. I would agree. I would put my hand up. I think the housing market is clearly healing. This is one measure of housing right here that we have. This is the existing single-family homes months of supply on the market. That's a handful. Let me say that again. It's just the number of months supply in the market for the largest segment of the housing market, which is existing home sales. So what we have here is the number here on the bottom is at four months of supply. To give you a reference point, back in 2009, as the housing market was crashing, we had close to 13 months of supply. The average on this series over a long period of time will be about 6 months of supply. So what does that tell you? It simply tells you that the demand for housing now is stripping the supply out in the marketplace. Okay, that's a very bullish development for housing. There's a lot of other indices we watch as well that are confirming the measure that we're seeing here. Housing looks like it's for real. Next, let's talk about jobs a little bit. We are encouraged by the trend in jobs that we've seen lately. Some of that probably piggybacks off of the housing story that we just saw as construction jobs are beginning to pick up. And the number that we see here is one of our favorite leading indicators for housing. It's called the unemployment insurance claims. We do smooth this number in a 4-week moving average. We average it up just to take some of the noise out of the number. But the real important part about this number is just to watch how this trend comes down. And this is literally, if you don't have a job, you're lining up in the employment, in the claims line to go pick up a check. So it's showing you right here, there's less and less lining up to go pick up a check. It's a healthy development for the economy. We're under 350,000 on this number. This is good news. And again, there's a wide swath of numbers that we look at on the job side. While they're not barn burner, they're slowly picking up in gradual fashion, and that's a real positive thing for the economy as well. Third, let's go to value situation. And let me just preface this by saying that my compatriot over here, the Italian stallion Swirl Locatelli, will cover the entire value equation that Pinnacle looks at. He's going to cover our model for you. But I'm going to pick one point out here and just mention that on a relative value basis, I think the story for stocks is still pretty good. So what I'm showing you here is two things. I'm going to show you the earnings yield on stocks. That's the blue line up here. And that's about a 7% earnings yield. It's simply taking the earnings, the E, over the price of, in this case, the S&P 500. And the red line, what you see is a 10-year treasury yield. Okay, that's a measure of safety in some people's minds, right? A risk-free right to some extent. It's about 2% at the moment. And so the point I'm going to make here is just simply that, to the extent that asset allocators are out there looking for relative value plays, and that's a lot of what we're doing, there is certainly a nice relative value play here at the 7% yield versus the 2% in bonds. So I think there's a good relative valuation story out there in the marketplace for equity. And then lastly, let's get to kind of something that backs maybe the theme of this presentation. You saw as you walked in, that nice big wave and the surfer, when the title was riding the liquidity wave. Well, where's that liquidity coming from? It's coming from central banks. Okay, the central banks continue to support asset markets. They continue to support growth right now. They've grown their balance sheet exponentially. To give you a feel here, and it's tough to see again, this is the central bank balance sheet of the Fed in trillions of dollars. This is about $1 trillion back in 2008 before we had the big bust. Since then, Ben Bernanke has been on a mission to try to reflate the economy. Right? He wants those home prices to go up. He wants those jobs to go up. He wants your stock market to go up so that you feel better, the wealth effect, right? If your house is up and your equities are up, you feel good, you're going to spend more. And that just kickstarts the whole economy, hopefully, and gets us into a good, positive, virtuous cycle. So the central banks around the globe, and in particular the U.S., continue to support risk assets. Again, I wouldn't say, we're completely sanguine on this. I mean, the reality is there will ultimately probably be some unintended consequences down the road. It's never good, right, to just continue to think you can print money and do well. But the reality is in the shorter term here, over the next couple of years, this could really propel asset prices, as oftentimes it does. So that's probably a positive on the margin for the next 6 to 12 to 18 months as well. So let me conclude this right now, because I'm sure I've busted my time budget right here.
Nope, you're good.
And it says I'm good. I pick up to 20 and I'm good. That's a double bonus. First of all, I'll say that the wall of worry is large. Okay, the wall of worry is always out there. There's always something for us to worry about. That's a good thing. If we're worrying, you don't have to. By and large, though, I think as we look across the landscape, I think there are a lot of encouraging signs here in the U.S. economy. Yes, there are a few things pressing against it that we talked about in terms of the gasoline prices, the sequester, those sorts of things. But the other parts of this equation that are moving forward, I think, probably get us to a point where we continue along in kind of a slow growth profile. And the message here would be that, while it doesn't sound great, maybe the optimum, environment for asset prices is sort of slow growth plus flush liquidity is coming out of the central banks. So with that, I'm going to get out of here and give my friend Carl Noble the floor to talk about internationals.
Okay, thank you, Rick, and good morning, everybody. I'm going to be spending my part of the presentation discussing the international outlook with all of you. I'm going to be briefly covering Europe, China, and then I'll finish up with Japan. Now, I should tell you that I'm a little more long-winded than these guys, so I probably will go over my time a little bit. Don't be alarmed if you, at times, hear the theme from Jaws start to play. That's just the cue for me to speed up a little bit. So I only have 5 slides, actually, so hopefully I'll be able to keep things moving. I'm going to start over in Europe when I think I can probably guess what you're thinking. And the short answer is yes, they're still dealing with a debt crisis, which is now entering its 4th year. Unfortunately, they haven't been able to make it go away yet, which forces us to talk about it with you again. So I've already gotten one question this morning about Cyprus, which is the latest domino to fall over there. It's just an indication that they continue to deal with the debt crisis. What you're looking at here is the 10-year government bond yield for 2 countries, Italy and Spain, over in Europe, which happen to be the 2 largest of the, let's call them the problem countries. And you can see that, the line on the chart is going higher. I should remind you that bond yields and bond prices move in opposite directions. So as the line is moving higher, bond prices are actually going down. Bond yields are going up, bond prices are coming down. As the line is going down, it's the opposite. Bond prices are going higher, bond yields are coming down. Now, I used a variation of this chart. I think this is the 3rd year running, actually. I've used some sort of chart showing European government bond yields. And the reason for that is they really act or serve as probably the best real-time barometer of how their crisis is unfolding. So it really gives you a good feel of how things are ebbing and flowing over there. And if we rewind the tape to a year ago, early 2012 when we held this meeting, again, I was using a version of this chart, and I was trying to paint a picture that things were really unfolding in a very worrying direction. So you can see in early 2012, even before 2012, the yields on these bonds had increased from around 4%, crossed up over 5%, and then continued to move higher. So again, early last year, I was telling you that these were moving higher. That was a signal that things weren't going very well. And in fact, following the meeting, the yields went much higher through the course of the summer. You can see that on the chart. Both Italy and Spain at one point both crossed 7%, which is considered to be a pretty significant threshold because that's what led 3 other countries, being Ireland, Greece, and Portugal, to essentially cry uncle and request a bailout. So that had already happened. The fact that these 2 countries had crossed 7% caused the market to start to speculate, geez, are Italy and Spain going to need to be bailed out as well? And if they did need to be bailed out, the big concern in the market was that they are much, much larger in size than any of those other 3 countries, so it was going to be much more difficult of a problem to solve if that was the case. But a funny thing happened, like just in the middle of the summer, or towards the end of the summer in late July actually, one person, the head of the European Central Bank, his name is Mario Draghi, he came riding to the rescue. And how did he do that? Well, he unexpectedly made some public comments that the European Central Bank was, quote, was willing to do, quote, whatever it takes to prevent a breakup of the euro. Now, those three little words, whatever it takes, may not seem like that big of a deal, but I can tell you that the market hangs on really every word that central bankers utter in the press or to the markets. And so, in fact, it was a very big deal. He really caught the markets off guard, but in a positive way. And so the markets quickly and immediately reacted to that. Over the course of the rest of the year, you can see that the bond yields for these countries, which were almost at a breaking point, really reversed on a dime and started to fall very quickly. So you can see they were up around 7% and fell back to a more normal level of around 5%, and even Italy went below 5%. So, Mario Draghi really performed sort of a superhuman effort by pretty much single-handedly engineering a big dramatic turnaround in the markets, and has gotten things to start moving in a positive direction. And because of that, he's now fondly known as Super Mario. So I just told you that things in Europe actually over the last part of last year have actually been moving in a better direction. There have been some faint rays of hope over there. But there's no doubt that the crisis has taken its toll over the past couple of years, and that's probably been best reflected in a significant underperformance of European stocks and other European securities. And so, it hasn't really been a great place for investors to be invested over this time frame. But at this point, there's kind of a potential silver lining in the fact that the degree of underperformance has potentially created some value opportunities that have people now interested in looking at Europe a little bit closer now again. There's an old market saying, which you may have heard, that the best time to buy is when there's blood in the streets. And that has literally been the case in some countries that have had mass protests against how their governments are trying to address the crisis over there. So in this case, I'm trying to give you a representation of the value that people are seeing. There's a lot of different ways to think and talk about value. In this case, what I'm showing is the relative performance of European stocks to the U.S. stocks. So the line itself is a ratio. It's the performance of an index of European stocks divided by the performance of the S&P 500 U.S. stocks. And the way you can think about this is if both indexes moved together all of the time and had the exact same performance, you would simply see a horizontal line across the middle of the chart here at 1. Now, clearly that's not the case. The line's moving all over the place. So what is that telling you? As the line is moving higher, that's giving you an indication that European stocks are actually outperforming U.S. stocks. And as the line is moving lower, European stocks are underperforming U.S. stocks. U.S. stocks are outperforming. So let's focus in on two specific periods on this chart. The first is roughly a 5-year period from late 2002 to the middle of 2007, roughly. You can see that European stocks were significantly outperforming here. The line was moving up almost this whole time. It was a pretty big move. Now, if you think back to Ken's discussion of our portfolio performance, the 2002 to 2007 bull market period was a period when we did pretty well. And a big contributor to that was that we had significant weightings in international stocks at the time. In fact, I think we had the highest weightings to international stocks that we've ever had over the course of our strategy. Now, the second period to take a look at is really since then, since the middle of 2007, up until about the middle of last year. And you can see the line just falls off a cliff. Europe dramatically underperforms over this time frame as the debt crisis really starts to unfold over there. And so this line here may not give you a great sense for order of magnitude or the degree of underperformance. So let me give you a couple of figures here. Since the beginning of 2008, the S&P 500, including dividends, is up by roughly or approximately 19%, whereas European stocks are actually down by about 32%. So that's a very dramatic differential that you're looking at between the two. But because of that, because it's been such a big differential, again, people are starting to think that there may be a little bit of value there because of that. And I can tell you over this time frame, specifically over the last couple of years, we've had some of the lowest weightings to international stocks that we've ever had. So we've really tried to reduce the impact of this type of trend that we've seen in the marketplace. Now, more recently, over the past 6 to 8 months, we've started to increase our weightings to internationals a little bit. And I should say that Rick will be up here a little later to talk a little more about our current positioning. But just to touch on the internationals for a second, Again, we started to gradually increase that back up as there have been some signs, not only the value that we think might be there, but also the fact that this trend, the line has stopped falling. Looks like maybe it made a bottom last summer and it started to rise. Granted, it's not much of a rise yet, but the fact that it looks like maybe it's turned around, is an indication that Europe has started to outperform a little bit over the last 6 to 8 months. So the next country I want to talk about today with you is China. These days China is just a critically important part of the global economic backdrop. The reason for that is it's grown to become the second largest economy in the world behind the U.S. China does a lot of trade, not only with the U.S., which we hear a lot about, but also with a lot of other countries, with Europe and their other neighbors in Asia. So China just sits at it's a very critical part, and there's a part of the global economy, and there's a good reason that investors try to keep tabs on what's going on in China these days. Now, what you're looking at here is China's GDP growth rate, so it's just the growth rate in their economy, and there's a couple of things on the chart for you to notice. So first of all, the scale starts at 5%. So on the left-hand side of the chart, it starts at 6% growth back in 1999. You can see that growth increased steadily till above 12% by 2005 or early 2006. So a very, very rapid rate of growth, much faster than we've experienced here in the U.S., obviously, or really any other developed economy has experienced over this time frame. Then China was hit by the financial crisis in 2007, 2008, just like everyone else was. The difference was that their growth did fall, but it remained positive. So you can see they fell from over 12% to down to around 6%. So while that seems great, a slowdown in the rate of growth of roughly 6% or a little more than 6% is still a pretty significant slowdown. So that did have a big impact on China at the time. You can see coming out of the crisis that, again, there was a big rebound back to close to 12% growth. But then an interesting thing has happened. Over the past few years, you've had a pretty steady decline again from around 12% back to below 8% last year at one point, down to around 7.5%. So again, even though it's positive, and most countries would kill for a GDP growth of 7.5% to 8%, in China, again, that's been a pretty significant slowdown. It's weighed on their equity markets and things like that. And so it hasn't been a very positive development for them. And it's led to a big debate in financial circles of whether or not they are headed for a hard or a soft landing. And what do we mean by that? Well, now the debate is really down to, some people think that this is going to get even worse and China's going to effectively experience a crash or a hard landing. And then other people think that China's just really undergoing an adjustment from a very rapid rate of growth to a lower, but still, a more sustainable level of growth around the 7 to 8% level. Contributing to this debate, you may have seen recently on 60 Minutes a few weeks ago, they did a big report about a potential real estate bubble in China, and they were showing ghost cities and things like that. And the implication in the report was that they could potentially be headed for the type of real estate bubble that burst here several years ago, and then have to deal with the fallout of that sort of thing. So there are compelling cases to be made on both sides of the argument, hard landing versus soft landing. I can tell you that right now we happen to fall into the soft landing camp. And the main reason for that is over the last few months, you've seen a variety of economic indicators look like they're starting to rebound in China. And that ranges from a variety of different things like manufacturing data, imports and exports, bank lending, and so on. And so again, there's still time for this to play out, but at the moment, we think that China is headed more towards the soft landing scenario, and if that is the case, then that's a big positive for the global economy. Okay, the last chart I have here for you today is a chart that focuses on Japan. Now, Japan has been a total basket case for a long time. Investors haven't made money owning Japanese stocks, for a number of years, and that's due to a lot of different things that have gone on with their economy. But some recent developments there have actually made it a pretty interesting case study for my goal here, which is to try to make a connection between Japanese stocks and their currency. Now, currency movements or the value of the currency in foreign countries may not be a big consideration for a lot of investors most of the time. But what I can tell you is that as U.S. investors, to the extent that you own or invest in international funds, like we do on your behalf in the portfolios, a lot of the times you are exposed to the fluctuations of the foreign currency, and at times that can have a pretty big effect. If the currency is appreciating relative to the U.S. dollar, that can provide a big tailwind and a boost to returns. And likewise, if the currency is depreciating relative to the dollar, that can actually act as a drag on returns. So what you're looking at here is the value of the Japanese yen measured in the number of yen it takes to buy $1 US. And so the way to read this chart is a little, it's a little counterintuitive, I guess I should say, but as the line increases here, as the blue line is going up, the value of the yen is actually weakening. It takes more yen to buy $1 US. As the blue line is falling here, the value of the Japanese yen is strengthening. It takes less yen, using this scale over here on the left, it takes less yen to purchase $1 US. And what you'll notice all the way on the far right-hand part of the chart is there's been a pretty dramatic move higher in the blue line, lower in the value of their currency very recently. Now that was due to, it's been mainly due to a big election that they held last fall. There was a change in leadership in Japan, and there's been some major policy shifts that they've undergone. And one of them has been specifically trying to weaken the value of their currency to try to help their economy out. So you've seen here, it's a little bit hard to tell on the chart, but that's about a 20% move lower in the value of their currency relative to the US dollar over just a matter of several months here. Now the movements of the currency are interesting, but there's also another very interesting relationship that I'm going to show you now that has to do with the value of the currency in relation to Japanese stocks. The red line that I just added to the chart is the Japanese Nikkei index. So that's their benchmark stock index. It's the equivalent of the S&P 500 over in Japan. And you can see that it looks like it tracks the direction of the currency pretty closely. I mean, I think that's a pretty impressive fit. Now, how do you read that? What is it telling you? Well, what it's showing you is that it seems like Japanese stocks seem to like a lower value of the currency. So as the blue line is moving higher here, again, the value of the currency is weakening. The red line is going up. Stocks are going higher. Blue line is going lower. The value of the currency is strengthening. Red line is going lower. Stocks don't seem to like that. Stocks are going down over that period. And over here on the right-hand part of the chart, again, you had a big jump in the blue line. The value of the currency was going down. Red line jumped as well. So the Japanese, this jump here in the red line, the Japanese stock index was about 40% over the last few months. Now, as a U.S. investor, if you had identified this and wanted to take advantage of it, what I can tell you is that most of the time, a lot of the common funds and things that you can invest in, you would have only earned about half of that 40% return in the red line, the 40% return in the Japanese Nikkei index. Why is that? It's due to the drop in the currency that I told you about. So again, you had a 40% move higher, roughly, in Japanese stocks, about a 20% move lower in the currency. So that 20% move lower in the currency pretty much took away half your return, again, for most of the funds that are out there. Now, I'll tell you that nowadays there are options. Well, I guess I should say, ideally, what you would have wanted to do is have exposure to the stocks and no exposure to the currency. And that's not really easy to do for a lot of the funds that are out there. I can tell you nowadays there's a growing number of options that allow you to do that allow you to sort of separate the two returns. And the point I just want to leave you with on this chart is that those are the types of considerations, those are important considerations for us as we try to evaluate different, opportunities in international markets. There's sort of that second layer that can be a pretty major factor. And with that, I'll just wrap up with a little bit of a conclusion here. Number one, internationals can be a pretty big swing factor for relative performance. What do I mean by that? Well, we saw the chart of Europe where there can be extended periods of international stocks outperforming U.S. stocks. Again, to the extent that we can identify that and hopefully take advantage of it, again, that can be a pretty big boost to portfolio returns. Number two, we do believe that there has been some longer-term value that has developed in some of these markets. Again, that's largely due to the fact that they really underperformed over the last couple of years. We think we've reached a point now where potentially it might be a good time to start taking another look at those. And then number three, again, we have been gradually shifting some of the chips in the portfolio back towards global over the past, let's say, 6 to 8 months or so. Again, it hasn't been a major move yet. We have owned a lot more in internationals in the portfolios at times than we do right now, but we gradually have been increasing those weightings a little bit, and we may continue to do so this year if we can continue to find attractive opportunities. I will tell you that it will probably be gradual because even though some value has been created there still are a lot of hurdles for some of these countries to kind of get through to have a higher degree of confidence that things are going the right way. So with that concludes my remarks today, and I'm going to turn things over to Sean Dillon.
Thanks, Carl. Good morning again to everybody. And as I said, I'm Sean Dillon. I'm the technical analyst at Pinnacle. And what I'm going to do is I'm going to walk you through our technical outlook for the S&P 500. First, what is technical analysis? Technical analysis is the study of price. And more simply, it looks at facts that are occurring right now. And I use those facts to try to paint a picture for where the S&P 500 will be going in the future. There's lots of different tools that I use, hundreds and hundreds of tools, that usually fall under one of these 6 areas. Those areas include trend analysis, which is very simply analyzing trends, momentum, which is the study of the rate of the rise or the rate of fall of stocks or anything else for that matter. We look at sentiment, which is the measure of bullishness or bearishness. And in this, we really dive into some investor psychology. We look at intermarket analysis, which is the study of asset classes and how they interact with each other. Market breadth, which is the study of participation within a market move. And last but not least, we look at seasonal patterns. You may have heard of the slogan that history doesn't repeat, but it rhymes. This is where we look at those rhymes to see if they can give us an indication of upcoming events. So for those of you who have been here over the last few years, it's going to look very similar. I'm going to touch on most of these areas to try to paint my picture. And those of you who are new, hopefully you can get a feel for our technical process here. So starting off, we're going to look at momentum. Again, momentum was the rate of the rise or the rate of the fall of stocks. And the top chart, we're going to analyze the S&P 500. And the bottom is the RSI. That stands for Relative Strength Indicator. And it's just one of the many momentum indicators that I look at. And really, with this momentum indicator, I'm looking for extreme overbought or extreme oversold conditions. I have 2 of them circled here. The first one occurred in 2010. And the RSI hit an extreme overbought condition, which means that stocks have risen too far too fast. And it's generally a warning sign that a correction or a pause in the trend is possible. In fact, the S&P 500, when this indicator hit the overbought extreme, corrected by about 15% in 2010. The next circle here shows an extreme overbought condition in 2011. After a few months of trading sideways, the S&P 500 then fell 19%. So once again, this gave us a good warning of an impending correction that was likely. It also works on the opposite extremes. The opposite extreme is an oversold condition, as marked by green here. As the RSI falls below 30, it turns green. Gives us that oversold condition, which did mark the bottom after the 19% correction. Fast forward to 2013. Once again, we're seeing the RSI indicator giving us an overbought condition, and this is warning us that a correction or a possible pause of the trend is likely. Now, I will tell you that the S&P 500, if you look at this line, has been in a very, very healthy bull market since 2009. And this indicator is just giving us possible warnings of corrections or pauses. It's not really signaling anything bigger than that. There's no bear market warnings here. And just one of the indicators. Keep in mind that this trend is still in place from the bull market. So nothing to really get too worried about. The next slide, I'm going to go through some intermarket analysis. In this case, I'm focusing on the dollar in the S&P 500. The reason I'm using the dollar is I'm seeing a very interesting picture develop here. The dollar has generally been considered a safe haven, which means that when people get a little nervous, they fly to the dollar, they start buying the dollar. They also buy treasuries and yen, and then they sell stocks. So it has a negative correlation to stocks, which means that the green line here, the dollar, when it falls, stocks generally rise. When the dollar rises, stocks fall. It's had a negative correlation for the past 5 years or so, as it's been the safe haven. However, fast forward to 2013, right now we're seeing a breakdown of this relationship. The dollar is starting to rise while the S&P 500 is continuing to rise. Now, if the relationship over the last 5 years holds true, this is a clear warning sign that once again people are becoming a little uneasy, a little bit nervous about the market rise, and we're due for a possible correction or pause in trend. In Inside of intermarket analysis, I also review what's happening underneath the S&P 500. I'm going to look at the different sectors and how they're interacting. And in this case, I'm looking at defensive stocks. Defensive stocks are your healthcare stocks, staple stocks, and utility stocks. And we call them defensive because they're generally recession-proof. They outperform or perform better than the S&P 500 in times of trouble because you always have to buy food and keep your utilities on and healthcare. And specifically, the blue line here is a relative strength line of the defensives over the S&P 500. So when the line is falling, the S&P 500 is outperforming, and when the line is rising, the defensive stocks are outperforming. As we look at the three lines that I have here, this has been a very good warning sign over the last few years of impending corrections that are possible. In 2011, the defensive stocks started outperforming. After a few months, the S&P 500 corrected about 19%. Once again, in the beginning of 2012, as the defensive stocks started moving higher against the S&P corrected, and again in the end of 2012. Oops, sorry, thought I had another line here, but I just want to point your attention to the end of 2013, beginning of 2013, we once again see the defensive stocks starting to outperform. This is signaling to me that people are starting to run to safety inside of stocks. They're selling their cyclical stocks that perform better when markets are, or growth is a little bit more healthy, and they're buying these defensive stocks or running to safety. And it's once again a warning sign that a correction or a pullback or a pause in trend is likely. Moving on to sentiment. Sentiment is alarmingly bullish. I was going over this presentation, practicing with my wife last night. She's like, "You really want to use alarmingly?" Might be a little too strong, but too late to change it. And sentiment is alarmingly bullish. In this case, we're looking at the MCI World Index, and we're looking at a sentiment indicator created by Merrill Lynch. What they do is they survey their fund managers, and they ask them how much of their portfolios are invested in equity. Whenever you have too much invested in equity, it's usually a bearish sign because think about it, if everyone has already bought all their stocks that they're going to be buying, there's no one left to buy your stocks at higher prices. That's why it usually gives you a warning sign, again, that a correction is possible. As we have circled here, whenever the survey weighting of equities gets above the 55% level or so, 56% level, it gave you clear warning signs that a correction is possible. And once again, in 2013, we are seeing that warning. So you can kind of see where I'm going here. We have a lot of warning signs that are building up. Now I have one question asked. Has anybody ever heard of the saying, "Sell in May and go away"? Sell in May and go away. That's a technical analysis saying. It is a study of seasonal patterns. And for those of you who don't know or haven't heard of it, sell in May and go away just says that there are 5 months of the year where stocks do not do well, generally speaking. And if we look at the past 3 years, sell in May and go away has been a very good seasonal pattern. In 2010, from May 1st through September 30th, the S&P 500 was down 4.27%. The rest of the year was just an amazing good year. 2011 down 16.3%. S&P ended that year up 1%. So the rest of the year was also very, very positive. 2012 the S&P was flat, up 1.4% during this period. So you can see that this seasonal pattern has been very strong over the last few years and in history in general. And just keep that in mind as we're leaving March here, entering April. We're getting very close to this period. Now, all of these negative indicators are telling me that a correction is possible. However, there has been one trump card over the last few years, and Rick alluded to that in his slide, where the Fed is increasing their balance sheet. The stocks love bond buying, and I'm trying to show you that picture here by using a HOMO chart. HOMO is permanent open market operations. It's just a fancy way of saying Fed bond buying. So that when the green line rises, that means the Fed's buying bonds and their balance sheet is expanding. And we're comparing that to the S&P 500 here. So you can see bond buying, stocks rise. No bond buying, stocks fall. QE2 comes in, Lots of bond buying. Stocks love it. They stop buying bonds in QE2. We have, another decline here. Then we have this thing called Operation Twist, which is a program designed by the Fed where it wasn't really increasing its balance sheet, but it was selling short-term bonds and buying long-term bonds. And, stocks generally like that as well, as we had, another uprise during that period, albeit in a more choppy fashion. But fast forward to 2013, we're back again in pure QE. The Fed balance sheet is expanding again. And, right now, that seems to be all that matters. When they're pumping liquidity in at the rate they're doing, $85 billion a month, stocks are rising, and it's trumping everything else that we're looking at the moment. So we have to keep that in mind and be careful not to get too defensive here. So with that, I'm going to just give you the summary. So if we look at the different areas of our technical process, the trend is still positive. Didn't really go over that too much in detail, but from 2009 to 2013, very strong bull market. Market breadth is also positive. There's lots of stocks rising. Again, we didn't review that area, but this is also a positive technical development. And then on the negative side, our seasonal patterns. We're about, getting close to the sell and May period. Momentum, giving us a warning sign that things have risen too far, too fast. Sentiment, overly bullish, and our intermarket analysis is showing some divergences in the relationship between the dollar and some defensive rotation is taking place, which is also a warning sign. And then finally, the Fed trumping everything else. We're going to keep watching and not get too negative while they're doing their bond buying program. So with that, I'm going to give the presentation to Soro. Thank you.
All right. Thank you, Sean, for showing us all those nice drawings. And we're going to talk about some actual science. Hello, everyone. My name is Soro Catelli. I'm Pinnacle's quantitative analyst. For those of you who were here last year, my presentation was an introduction to quantitative analysis and how we approach it at Pinnacle. For those of you who missed it, we actually posted the presentation to YouTube, so you can go check it out. I believe the video right now is about 1,800 views, which is impressive, although half of them are from Ken, who's still trying to figure out what the presentation is about. So this year, we're going to take it to the next level, and we're going to talk about one of the most important quantitative models at Pinnacle, which is the Pinnacle valuation model. The goal of the model is to value the S&P 500 index, which is perhaps the most widely followed index of U.S. equities. It's also the index that the equity sleeve of your portfolio is benchmarked to. So that obviously makes it very relevant for you and also for us. This model, the valuation model, has been at Pinnacle for many years, but over the years it has seen continued improvements as we always try to incorporate the latest research into the work we do. Specifically, the recent efforts have been focusing on improving the quality and the quantity of the factors in the model, improving the way that we extract information from each factor, and finally, introducing a level of optimization into the model. And optimization is just a fancy word to say that we wanted to tilt the composition of the model towards the factors that have shown to work the best. So research shows that valuation is not very effective at forecasting returns in the short term, for instance, over a 6-month time frame, but it is very effective at forecasting returns in the long term, which typically goes from 5 to 10 years out. And in a few slides, I will show you that Pinnacle's valuation model has actually been very effective at forecasting long-term returns. Currently, we have 15 factors in the model divided in 4 categories. The first category is price to earnings measures. And in this category, we have a bunch of different PEs ratios, where the main difference is in the way the earnings at the denominator are calculated. The second category we call yield-based measures, and here we're just looking at the either the dividend yield or the earnings yield of the S&P 500, and we're comparing it to competing assets such as treasuries, corporate bonds, as well as inflation, and see how they compare on a relative basis. The third category, we call it non-earnings measures, and here the idea is very similar to a PE ratio, except that instead of the earnings, we're looking at some alternative measure of company performance, such as sales and cash flow, because these measures are not as easily manipulated by the management of the companies. And then finally, we have the intrinsic value category, where we take the market price of the S&P 500 and we compare it to a different measure of value, such as book value or replacement cost, for example. So as you can see, we look at valuation from many different angles. And actually, Rick, in his making his bullish case, he already touched on one of the factors that we have in the model, which is the Fed model in the yield-based category. And as he pointed out, because of how compressed bond yields are right now, this particular measure of valuation is looking very attractive. And actually, we're getting a very similar message from all the other factors in the yield-based measures. So we could say that that category right now is the bright spot of valuation. However, there's also a dark side of valuation at the moment. And unfortunately, we don't have the time to go over any individual factor. But we can say that in general, price to earnings, this shows that yield-based measures are looking cheap right now. As I was going to say, we can say that price to earnings measures are looking fairly expensive right now, especially the ones based on normalized earnings, which have been more reliable historically. And also non-earnings measures are not looking cheap either. And what's left is an intrinsic value measure all the way to the right, where right now it's kind of a mixed bag. So as you can see, right now we're getting different and at times opposite messages from different factors that we have in the model. And we, when we are faced with this kind of situation, what we don't want to do is just pick and choose which factor to follow and just hang our hat on one or just a couple of factors just because we like them better or perhaps because they fit our overall view better. But what we want to do is use a model that will objectively analyze the message coming from each factor, as well as how the different factors interact with each other, and give us a single, objective message that includes all of the evidence available. And that is exactly what the Pinnacle valuation model is designed to do. So let's take a look at it. The red line that you see on this chart is the output of the Pinnacle valuation model. The relevant scale is on the left side of the screen. You can see that it goes from 0 to 10, where 0 represents the most overvaluation and 10 represents the most undervaluation. And I'm going to draw another line, this blue line here, which is scaled to the right in this case. And this is this line at any point in time represents the 10-year annualized return of the S&P 500 that was actually observed over the following 10 years. Now let me clarify that concept with an example. For instance, on February of 1985, the Pinnacle valuation model was reading 7.8 out of 10, as is highlighted by the yellow triangle. And typically we would consider that to be a very attractive value. Now, if you invested in the S&P 500 at that time, over the following 10 years, you would have achieved an annualized return of 13.8%. And that is what the value of the blue line at the same time is telling you. Now let's fast forward 15 years. We are in January of 2000, and the Pinnacle valuation model is reading 0.3 out of 10. That is one of the lowest readings we've ever seen from the model, and it's not by accident that it coincided with the peak of the tech bubble. And if you invested in the S&P 500 at that time, over the following 10 years, you would have achieved an annualized return of just negative 0.9%. So the huge difference right there. Now, you can see that the red line and the blue line track each other pretty closely over time. There's only one significant exception, which I circled out for you. And at that time, the blue line is significantly above the red line. And the explanation for that is if you invested at that time in the S&P 500, it was about 1989 to 1990, your 10-year investment period would have ended at the peak of the tech bubble. So you would have sold at the peak of the tech bubble. That would have allowed you to achieve a higher return than the one that valuation at the time that you made the investment, would have warranted. So that makes sense, and actually we could say that it wasn't the model being wrong here, it was more about the market being irrational 10 years later. Now you see that the blue line doesn't go all the way to present, it actually stops here. That is February of 2003. That's the most recent 10-year period that we have completed. It makes sense because we find out where the blue line is going to go only 10 years later. But we want to take a peek at how the model is performing beyond that date. So we're going to draw this white line right here. And that line represents the annualized return that we have seen from each of those dates until the present. And so those periods are not quite 10 years long yet, and actually they grow shorter as we move forward along the white line up until the last point on the line, which is February 2008, and that is a 5-year annualized return since then up until today. So you can see that even when we look at more recently, over periods of time shorter than 10 years, the Pinnacle valuation model is still being very effective at telling us what kind of returns we should expect in the future. Now, in my last slide before I wrap things up, I want to show you the performance of the model in a table format because I want to put some numbers to it. In this table, each row represents a 1-unit range for the model, going from the top of the table where we have the lowest, least attractive valuations, and then going down, we actually go up in the score until we get to the highest and most attractive valuations. Now, as we move towards the right on the table, first, this column here is the average 10-year annualized return that was actually observed in each of these ranges from the Pinnacle valuation model. And then as you keep moving to the right, you have the maximum and the minimum return that were actually observed from each of those ranges. And finally, the frequency all the way to the right, which tells us historically how often we have been in each of those ranges. Now, the first thing that I want to point out is the very nice progression that you see in the average 10-year return as you move from the top of the table, from the least attractive valuations, down to the most attractive valuations. You see the average return increasing very gradually. And that tells us that the model is doing exactly what it's supposed to do. You also see a very nice progression in the maximum and minimum return, so that's also a very good sign. Now, this table, as I said, shows you the historical performance of the model over the past 30 plus years. But we can also use it to form expectations about the future. And right now, the Pinnacle valuation model is in the 4 to 5 range. And historically, from this range, we've seen average 10-year annualized returns of about 8.4%. And obviously, as we move forward, we could see a higher or lower return. But we can use statistical inference to say that there's a good probability that we'll be somewhere in between 10 and 5%, which were the maximum and minimum returns that we have seen coming out of this range. Just to make it clear, the 8.4% will be the return of a portfolio that is 100% invested in equities. If we want to talk about a moderate portfolio such as DMG, which is 60% equities and 40% bonds, then if we assume that bonds are going to return about 2% over the next 10 years, 2% is the current yield on 10-year treasuries, then that would imply a return for DMG of about 5.8%. There's one final caveat that I want to make, and that is the Pinnacle valuation model tells us what kind of return equities are priced to achieve over the very long term. However, it doesn't tell us what kind of volatility we can expect in the interim. And actually, if the next 10 years are going to have any resemblance with the past 10 years, then we can assume that it's going to be quite a bumpy ride. So that's exactly why we are not going to invest for the next 10 years just based on valuation. But as Ken explained at the beginning of this presentation, we invest for cycles. So the information that you see on this board is certainly a valuable piece of the puzzle, but you should not expect it to just drive our investment decisions over the next 10 years. So wrapping things up, as I promised, today we looked at the Pinnacle valuation model, which is currently neutral. I've shown you that it has been very effective at projecting long-term returns, and currently it's projecting a 10-year annualized return of about 8%. And there's one key takeaway from this presentation, and that is whenever you're facing conflicting evidence coming from different indicators, you should never pick and choose which one to follow, but you should try to always consider all the evidence available as objectively as possible, and that applies to valuation as well as other things. And with that, I want to thank you for staying awake, and I'll hand it back to Rick for our conclusions for today.
Thank you, Sora. Perfectly done. Okay, 2 more slides here, and we'll get to some Q&A. We just want to wrap this up. I mean, I think Sora just said it best right there. We're a shop here that will not rely on any one indicator. We look at a broader amount of categories here, right? So we had valuation, we had technical, we talked about the business cycle both in the U.S. and internationally. We look at the weight of the evidence in these areas, and we look at a lot of indicators, not just one. So maybe we can wrap this up in terms of our overall outlook here and kind of guide you as to how we're positioning things here. So getting back to the business cycle, wrapping things up, I think the reality is that the U.S. economics here are marginally improving, and that's a good thing. The internationals on the other side are probably stabilizing, certainly in Europe, and we're in the lower risk soft landing camp for China at the moment. Technicals, as Sean said, on the technical front, obviously, a few worry signs here. But as Sean, I think, said quite well, most of those indicators are sort of shorter-term indicators, telling to us that perhaps there's a warning for some sort of a pause, but that doesn't mean the bull market has to end either. Thirdly, stocks are kind of in this middle camp here. We don't think they're particularly cheap, and we didn't get into the indicators there, but Soro mentioned that a lot of the indicators out there aren't as rosy as the one I had mentioned. So plenty of things that can tell you that the S&P is, in the markets are maybe fairly valued or perhaps a little overvalued. But on the other hand, I think that the relative value story continues to be a big part of the story here. And certainly that stocks versus bonds situation is still in a favorable spot. So not particularly cheap, but decent relative value. We didn't really go over any of our quantitative models other than valuation, but we look at a lot of quantitative models. We run our own engine here that Soro puts together. All of the models that we look at the moment are telling us they're generating moderately positive signals. And the last bucket that we typically look at is system risk. In other words, are we worried about another blowout, like the euro might not exist next year, that sort of a thing. And I can tell you that most of the indicators that we watch there have all calmed down, which is really a pretty positive thing. So what do we get from this right now? I mean, I think at the end of the day, our theme here is that we're riding the liquidity wave that we have at about benchmark levels of risk. Okay, now we've been somewhat in this sort of camp since last year. If you remember last year when we put our theme out, it was sort of a tale of two tails. We could have upside tail risk in terms of a market melt-up or downside. We're not there anymore. We've sort of gotten our portfolios back to a place where we're close to benchmark. Some of you will notice that we had a flurry of trades go off on Thursday, right? That was really just to take some of the cyclicality down in the portfolio. So it got to Sean's chart, where people are starting to rotate a little bit more defensively here. We're starting to do just a little of that. And so at the end of the day, when you look at our portfolios, they should be about dead on the benchmark right now, and that's where we think we should be. In other words, we have to respect that a pullback will be coming, but we also have to respect the fact that there's a gobs of liquidity out in the system that can keep this thing riding for longer than people think. So, as we continue to do our work, a lot of sector rotation will continue to dominate the work, and that happens both in our U.S. sectors, our fixed income markets, as well as the international markets that Carl talked about. Do a lot of rotations here on a relative value basis. And essentially, we'll continue to watch this thing, let the good times roll while they can and make the profits we can, but, also keep a careful watch and an eye for the exits in case we see some dangerous divergences develop.